Hey guys, what's up? It's Ryan, your boy. In today's video, we're going to talk about what in the hell is going on in the real estate investing market. Let's dive right in. So I am hearing a lot of people complain. I'm hearing things like, oh, response rates are lower. People can't afford to sell. People want to sell for what the market was back in 2021, 2022. So let's just talk quickly about what the problem is, and I'm going to give you the actionable solution that you've come to know and love from following moi. So back in 2019, I'm not going to call it what it was because I don't want this video to get limited because it has a keyword in it. Something happened that made real estate get weird, right? What then happened is the government reduced interest rates to try to stimulate the economy, and they maybe went a little bit too hard for way too long with 2 and 3% interest rates. Guys, on my house here in Florida, I got a 2.25 and delicious, right? I don't think in my lifetime I'll ever get that good of a rate again. Something that people like to forget was that we only had these low rates for a period of like a year to two, right? Historically, the average interest rate since back in, I think 1971 was when I was looking at, has been right under 8%. So right now we're actually better than historically average. It doesn't feel like that because we just had really good rates for a long time. You've probably noticed this in other aspects of your life. I don't know if you took an Uber recently, but I live 1.5 miles from the airport here in Pensacola. My Uber recently to get home was like $37. I was like, what on earth? Well, Uber raised a whole bunch of money and they were literally subsidizing your rates with venture capital, literally paying for part of your ride for you. Uber didn't get more expensive. It was always more expensive. Uber itself was just subsidizing the cost. Kind of similar with real estate. Real estate has always been expensive. It was just kind of subsidized with these low rates. So back in 2021, 2022, the problem if you were a real estate investor was low inventory, and everybody and their mother thought they had just $1 million opportunity, right? You could have a crack house in Gary, Indiana, and they'd be like, oh, it's a great just because there's no inventory, right? That was the problem, was we had these super low rates, crazy bidding wars where people were just selling for top dollar and it was moving quick. Well, why was inventory low if stuff was selling for so much money? Well, a couple reasons. One, if I'm selling, that means I then have to get into those shark-infested waters to try to find my next home if I'm a retail buyer, right? So there was that. The other problem we had was people weren't quite sure what was going to happen in the market and in the economy. Anytime you have like blood in the water, like negative news, like more than normal, right? People kind of pause, like what's going on, what's happening. And honestly, I think we're seeing a lot of that now, which I'll get to in a second. So fast forward to 2023, everybody was like, oh, the market's going to crash when interest rates go up. Property values are going to get cut in half. That hasn't happened. I just listed a flip on Monday in Louisville, Kentucky at $225, and we got bid up to $240 cash, no inspection, no contingencies, no appraisal, close in 20 days. Yeah, the market's still stupidly hot, right? That $225 is actually higher than we thought it would even sell for. I just penned it on another flip down here in Pensacola. I thought I would get 180, 185. I got 197, right? So the market is not kind of fallen off of this cliff. But what you do have happening, people are hoarding these low interest rates, and who can blame them? I mentioned I've got this 2.25 on my house here in Florida. I have to move to California in a couple months. My wife's a Navy psychologist. I don't have a choice. I have to move. Doesn't really make sense at all to keep my house here as an investment. Won't cash flow as an Airbnb, won't cash flow as a single family rental, and taxes and insurance here exploded due to some hurricane stuff where like just doesn't make any sense financially to keep the house. So I'm going to sell it. That rate is going to go away. As I'm looking at places in California, I'm looking at 6-7% plus rates, right? So I feel for the people that are like, no, I don't want to lose this 2%. The other aspect we have with that is kind of what I mentioned with that event that shall not be named that happened in 2019. Right now, there's some fear in the water, right? There's war and crime and budget deficit and inflation, and the commercial market's an absolute bloodbath right now. So there's all of these factors, plus rates are higher, where the average person that isn't forced to move like me is sitting back and going, what's going to happen? Is it going to get better if I wait? Right? And fact of the matter, what we're seeing with sellers, a lot of them don't want to admit that they've missed the boat. Like, not by a little bit, like it's gone. I don't see a future anytime in the foreseeable future where rates are at 2% again. I just don't think it's going to happen. So they're like, well, I still want this. Well, in order for you to get that, so I was looking at an expensive house in California. For me to go get a new mortgage on this place was like 19 grand a month. The current owner pays like 8. Kind of hard to justify buying it for what they bought it for when the affordability is so wildly different. That affordability means you have people that maybe locked in a lower rate or refinanced into a lower rate that now can't afford to or don't want to move. So they're kind of hoarding. If this is something that you're not actively doing, I want you to like this video. Just a quick, hey, I got value out of this. It's been a little while since I've dropped something for you guys, right? Give me an attaboy. Have you heard of the 80-20 principle, right? States that 80% of your results comes from 20% of your efforts. So I've got kind of just an honest check that I want to hit you with. If you're hearing from sellers, I've got this great rate, why would I sell, right? Why in the hell are you marketing to people with a 2% interest rate or a 3% interest rate, a sub 4% interest rate? Literally makes 0 sense. We know they're probably not likely to sell, so let's just exclude them. And I'm going to show you literally step by step how to do that in both PropStream and ListSource. Second point I've got for you, just Google commercial real estate if you're bored. I think the last thing I saw from The Real Deal was that there's something like $1 billion of commercial loans that are getting defaulted on right now every single day. I don't know about you, but that doesn't sound like fun. Well, why are people defaulting on commercial real estate? Well, let me tell you. People bought these buildings at absurdly inflated valuations, they call cap rates, because interest rates were low and inventory was tight. People wanted to get in on the action, right? The smart ones locked in those rates. They did 20, 30-year, whatever kind of locked in debt they could get. A lot of them didn't. They did adjustable rate mortgages that reset typically every 5 to 7 years. So what you have going on right now is somebody bought, say, an apartment complex, and they said, hey, this thing cash flows 10 grand a month at a 5% interest rate, right? 5.5 was like back what we were seeing on commercial debt back in like 17, 18, 19, 20, right? The problem now is they're not able to get that kind of rate. So let's say I was hoping I'd refi into a 2 or 3%, just this low, juicy rate. And what I'm looking at now is 7%. All of a sudden, these things burn money. They're alligators. They don't cash flow. They're literally bankrupting people. So what are people doing? They're walking away. They're filing for bankruptcy. They're turning the loans in if they're non-recourse. So that's what's going on in commercial. But I've got a secret for you. Did you know that homeowners do the exact same thing? Maybe you're super smart, like me, and you're looking at excluding people with these low rates. But are you going after people with balloon mortgages? I highly doubt it. There are people that will buy a house with a loan structure that requires them to pay off the loan or refinance in a certain amount of years. There are those actively coming due right now in your own backyard. So I'll kind of rephrase my question. We started with, why in the hell would you market to people with 2% rates that just bought in the last year or two, unless they're expired on the MLS or something, right? If they're actively trying to sell it, great. By all means, go after them. subject to creative finance, whatever you want to do there. Why would you also not be going after the opportunities right now that have to pay off or refinance? Kind of a no-brainer. Literally, they pay it off, they refi, or they lose the house. Those are the three options. So I'm going to hop into my laptop here and show you step by step how to pull these in your own market. Now, at this point, if you're like, got it, that makes sense, sold, and I'm lazy, just head up Ballpoint. I'm going to drop their link below. They will literally pull these lists for you in your own backyard and send mail to these people on your behalf, written with pens. Doesn't get more simple or easy button than that if you're lazy like I am. I got to preaching a little bit on this one, so went a little bit longer than I'd intended. So I actually shot a part 2 where I hop into my laptop and show you literally how to pull these yourself. If for some strange reason you're not just going to do what I do, which is use Ballpoint to get the results that I get. Be sure to like and subscribe if you haven't. I'll talk to y'all next time.